Welcome to the Broken Pie Chart Podcast, episode 354. I'm your host, Derek Moore. Once again, back with me, Shane Skinner and Mike Snyder. Okay, consumer sentiment came out, and JC Peretz retweeted Kevin Gordon's tweet saying another new all-time low for how consumers feel about the current economic environment in December, per the University of Michigan. JC Peretz also added, this is historically great news for the people who own stocks. Like, we've been on this for a couple weeks. People are unhappy. Their sentiment is very low. There's almost extreme fear, even though we're near all-time highs. So, yeah, I mean, the sentiment numbers were not good. Bloomberg has a screen or a function that actually breaks it out by political affiliation. And so what they did was they said, I guess when they do these surveys, they ask, hey, are you a Republican, Independent, Democrat, whatever. So the headline number was 53.3. Republicans was 88.7, Independents was 50.9, and Democrats 33.6. I'll remind people that before the election, this was completely flipped when President Biden was in office. And to go a little further in this, let me see. Inflation expectations 1 year out by political affiliation. Let's see what this is. So Democrats, 5.2%. They believe inflation is going to be 5.2%. Independents, 4.7. The headline, that's the aggregate of everybody, 4.1. Republicans, 1.5. And then you look at, well, at least over 5 years. Let me see. Oh, you know what? They didn't list Republicans for 5 years. So I can't tell you what that is. But independents are like 3.9. So, all right. So people aren't happy. And typically the contrarian play would be to buy stocks. Shane Skinner. I mean, we have talked about this. We've talked about the data where it really doesn't matter who's in office. Like, markets over time go up. We don't know if they're going to go down. That's why we hedge. But I mean, look, this was totally flipped 6 months ago, Shane.
Yeah. No, I don't think it's any surprise that you see when one party is in charge at the time, it's rosy and everything's peachy, positive thinking on that side, and it's doom and gloom on the other. This is like historically how it always goes. So I don't think this matters nearly as much as, things like forward earnings, what is actually going on, how are companies doing, and where I think this could become problematic. You talk about fear, is when fear actually turns into flows and action. I know I sound like a broken record here, but if enough people actually stop believing, or they believe it's better to take their money elsewhere than the equity market, we could see a pullback. But at this moment in time, I mean, it seems like business as usual. I think there's quite a few other things going on that, we'll get to later. The Japan thing, I think that's interesting. But as you know, that was the first thing I asked you today was about it and why I shouldn't believe the red flags headlines saying that, it's doom and gloom because Japan might raise rates. But like we said, we'll get into that later.
Mike, I mean, when you look at this, and again, it was completely flipped. The 1 year high for sentiment for Democrats was almost 70. For Republicans was 97. So, okay, so their sentiment is down a little bit. But I mean, the headline, I don't know, within the last year was 74. So this just is contrarian to the fact that the market's at all-time high. And I think it's kind of a point, Mike, to think about. People may feel this way, or maybe they're surveying the people who don't have money in the markets, but they're not voting with the buy-sell button, right?
Yeah, that's exactly what I was going to say. What are the actions behind, this report, and consumers who feel uneasy about the economy? Are these people who, have a bad outlook or feel a certain way about the economic environment? Are they selling their equities and sitting in cash? I mean, I think you can feel uneasy about the economy, but still, and that, that's a feeling, and still think to yourself, well, I'm not going to go to cash because look at this market. I think both things can be true.
Mike, maybe they're buying gold, and I don't know who this is. Bullion Vault. I'm sure they're trying to sell gold, but it's a visual capitalist chart. Mike, if you would have bought $10,000 in gold and $10,000 in equity 25 years ago, you would have $126,596 in gold and $77,495 in stock. So they're both up over 25 years. Not surprising. But gold is definitely continues to, even though we had that retracement. I mean, Mike, maybe they're buying gold. Maybe that's where they're putting the money.
That could be it. It could be a rotation of gold. I still, even if you tell me that you're feeling unsure about the economy, it would still surprise me if a majority of these people polled are actually doing something like that.
Well, it's just like the investment banks. I mean, the investment banks will say, our target is, I'm making this up, I don't know if anybody has a 4,000 target on the S&P, but they'll say, yeah, our target's 4,000, or wasn't it Morgan Stanley or JP Morgan? Was it 2 years ago? They were always saying that the market was going to go down. They had the wrong call. And again, that's very, very difficult to do targets. But I don't think they were telling their clients go to cash.
Right.
That's so. All right, we'll see what happens here. Mike, you don't buy it though, right?
No.
All right, there we go. Shane, let's talk about Japan. So let me give a little context here. Japan, and you have this in what I sent you. We don't usually get into the interest rate expectations for Japan, but why not? So are they really doing the meeting the same day? December 19th, or is ours? Anyway, they are 89% probability of a hike. And if they hike, they'd go from a target rate of 50 basis points, so 0.5% to 0.7%. And then you look, and their trajectory is of raising rates. So you get out to by October of 26, and I'm sorry, I don't have past October of 26 Japan probabilities for interest rate hikes, but they have the implied rate going to about 1.02%. You look at the 10-year for Japan. Japan's 10-year made another fresh, not all-time high. That would have been back in, 98, but maybe 2006. But we're very close to where the 10-year yield in Japan was in 2006. Shane, I got to be honest with you too. Like, Japan kept rates low forever. They kept them low for years and they didn't have growth. They kept them low for years and they didn't have inflation. And they kept them low for years and their stock market never made a new all-time high going back to the late 80s. I was saying a while ago, like, why don't they try something different? Just raise rates. And I get it. They don't want their currency to get too strong because of the importing of stuff, and they don't have natural resources like oil. But Shane, like, I'm not too worried about this. Maybe I should be. But tell me why should I worry about this, Shane?
If the carry trade hasn't unwound, which who really knows if it truly has? I don't know where to look. Maybe you do. If not, maybe one of our listeners can better inform us. But that's the one thing that in my 5 years of being in the market, I remember a couple of years back, right? Was it 2 Augusts ago? Was it last August in 24, or was it August of 23?
August of 24.
It was. Okay. And that's where we got a pretty nasty month in equities, right? And then all of a sudden, at the end of the month, I think the Bank of Japan came out and said, okay, we're not going to raise anymore. We're going to pump the brakes. And the market sort of calmed down for a second. I think there's risk there, potentially, if that's still in play. I think there's also when interest rates move, it gradually down the line affects flows in some manner or form. I don't know if this would cause more money to flow into Japan and out of the US. I'm not saying it will. I'm not saying it won't. It's just, it's kind of a big deal, right? Like you just said, they haven't raised in so long. So something like that to me matters. And I think it's worth paying attention to, whether it affects US equities or not. I guess we'll see. But hey, they're implying 1% by October 30th of 2026. And we're at, is it 0.5% right now? That's doubling. So to me, when an interest rate doubles, maybe it's not that significant, but something like that in Japan, who knows? We'll see.
I mean, my thought is a lot of times when you have, the carrot trade, it wasn't a blow up, but it certainly caused some unrest. That was, I believe it was July or August of last year. I'd have to go back and look. A lot of times, though, when that happens, the people doing those trades either take them off, they put on hedges, they reduce the risk. Like, I feel like the thing that was a problem then isn't necessarily going to be the next problem. It might be something different. I could be wrong.
It's not like a housing crisis necessarily. It's not like you've got some horribly awful thing going on necessarily. It's more so didn't they state that their concern is rising inflation and rising wages, and they just kind of want to maybe see if raising rates will stall that a little bit. Yeah, to me that doesn't sound like they're panicking, and like you said, eventually the trade unwinds and it just no longer has downward pressure or effect.
So where this comes in is let's say you take rates and you keep rising. They keep rising. Okay, so Japan's currency gets stronger. That's usually not a great thing for them. But then the other part of this is there some mechanism where they have to sell U.S. treasuries? So Japan does hold U.S. treasuries. And that, I think, is, you asked me, on our chat, and you said, I don't think it's equity. It affects U.S. equities. I think it could affect U.S. treasuries, meaning if there is a rush to sell some of their holdings or all their holdings, I don't think that, but they're going to sell some bonds. You sell, it puts pressure on price. Price goes down, interest rates go up. Maybe that flows through to our treasury market. Although, I don't think they hold as much as people think. I believe they hold roughly 4-ish% of the total debt. So, it's substantial, but it's not huge. So if they sold all of their bonds, what would it do? Would we absorb it? I don't know. Maybe we would, maybe we wouldn't. But I think your point's well taken, Shane. Like, when you see interest rates change that much and it's a paradigm shift, sure. I think, you never know what's going to break until it breaks. And we saw that in Europe too, when the gilt rates went higher, it caused problems in some of the pension plans over there with bonds.
Right.
So
yeah, it's sort of like you mess with one variable and you don't necessarily know what else on the table it's going to affect, where it's going to jump to, or, and I think all the central banks across the across the globe, would you agree, have gotten pretty good at responding to issues that arise from doing certain things.
They're getting creative, that's for sure. But all right, can we be done with Japan?
Please, okay. Mike, get us out of this.
Mike, let me move on from Japan, unless you have any thoughts on Japan.
You guys nailed it.
Okay, great. Glad to know we're the experts here. I want to get back. You mentioned earnings, and it all comes back to earnings. Jurrien Timmer had tweeted out, a bubble can't be a bubble without a valuation extreme. And so far, we don't have one, at least not for the major averages or the Mag 7. We can argue about the quality of earnings given the circularity of vendor financing and the use of depreciation timelines. But to my eye, at least, this is a cycle in which valuations are no longer the driving force. He has a chart, earnings and valuations. So he's got a chart where you've got the 5-year CAPE, So normally it's 10, right? I had to cough there for a second, so I hit the button. Normally it's 10. He's got a 5, and I believe I heard him talk about it where he said that he likes the 5-year instead of the 10-year. And then the second part of the chart is you've got 5-year EPS growth. So that's the growth in earnings, and 5-year change in PE. And he's got two big rectangles, Mike. I know you're looking at it right now. You go to the .com year, you had 14% growth in earnings per share over 5 years. That was the 5-year EPS growth rate. I don't know if that's annualized or an aggregate. Maybe it was annualized. And then you look at the pink portion, which is the 5-year change in PE, meaning let's assume, stocks got more expensive on a PE basis. The number of times earnings they were valued at went up. You look at this period right now, earnings growth, EPS earnings growth over 5 years, 14%. But look what's not present there. If I'm eyeballing this, is it 2% growth in PE ratio over 5 years?
Yep.
So the point of all this, Mike, is this rally or this period in the markets, it's earnings growth is the driver. It's not PE expansion, right?
Yeah, I think it sort of goes back to, what we were talking about earlier with this being a hated rally. Like, I think to some investors, it feels like it could be a bubble, and it's a buzzword. And there are, on paper, maybe, similarities to the internet and the AI boom. But when you look at the numbers and the facts, it's not there. This is a completely different period we're in versus, the internet boom and the .com bubble, and, the numbers show it.
Isn't it interesting too, Mike, that, you look at 2004 through, I'd say, it's tough on the scale here, maybe 2007 or so, 2009. I don't know what that covers. Probably that, that probably covers all the way to the trough of the great financial crisis. Yeah. But earnings grew 14% at the high. But then you look at the growth in the PE, and the PE, the multiple started coming down. I mean, this is why when we do that whole thing, where do returns come from? It's like, what's the multiple growth? What's the earnings growth? What's the sales growth? The expansion or contraction of margins, and then your dividends. So, I mean, Mike, is there a world where we do get a valuation sort of thrust here and PEs expand? That would be something, right?
I think they could. I also, could see them come down a bit. Not to play both sides, but I sort of see there. I think there was a point where you could just buy something if they said AI and you did pretty well. It seems like that's shifting, and it's been shifting at least for a few months, where there seems to be a little bit more scrutiny in terms of how companies investing in AI and building different products related to AI are being evaluated. It's not, just close your eyes and buy AI. And so I think that could have an impact on the earnings, the PE moving forward.
Shane, I mean, you look at this and we say, we're going to do our predictions. And I always say, when you predict at the end of this year what the market will be next year, you're really trying to nail, okay, what's the EPS going to be, or the forward EPS estimate going to be next, December 31st of 2026. But Shannon comes back to, is the forward PE going to be 15, or is it going to be 25? Like, that's the wild card in all this, right?
Yeah. Yeah. I mean, that's time and time again, that specific measurement seems to be the main driving factor and where a lot of the money goes. So it's sort of like, I don't know. It doesn't seem like there's really that much else to look at, right? When you chalk it down to what our returns what's responsible for returns on stocks. It's that.
Charlie Bilello tweeted something, and he did this because apparently Walmart is moving its listing to the NASDAQ next week with its market cap fast approaching $1 trillion. I think he even says, I don't know if this is in jest or if he's serious about this, Magnificent 8. And you look at the forward PE ratio for Walmart, it's 43.54 right now. To put that in context, the forward PE ratios are listed as follow. And this, again, I'm quoting him. Tesla, 277 times forward 12-month earnings. Walmart, 44. Nvidia, 39. I'll get back to Nvidia. Apple, 34 times. Amazon, 33. Google, 31. Microsoft, 30. Meta, 26. Think about this. Walmart is trading at a higher forward multiple than Nvidia, Mike. Like, okay. I don't know. I mean, I got nothing to say about that, really. I don't know why.
Yeah, so I was surprised. I didn't know that till I saw this. I would have almost guaranteed you that wasn't the case. Yeah, surprising.
I wonder what Domino's. Domino's is always the comparison for Google because they IPO'd at the same time. Do they still trade? Does Domino's still trade? Let me look. Domino's.
Absolutely. Crushed it.
Domino's.
PZ.
Oh, PZ is the...
DPZ.
Oh, DPZ. Okay, hang on. Let me do this on the fly. I'm going to look it up here. I've got to be honest. I'm not often doing fundamental analysis on Domino's Pizza. So give me a second here. I got to get to the right screen. I'll do that.
I do remember when they were being talked about as an up and coming tech company because of their pizza tracker.
Well, they own.
He's going to do shopping for you. Apparently, Walmart's partnering with them. It's going to help people shop. So,
well, I mean, but the point about technology is, like Domino's. I mean, look, from the New York area, New York City, right? Domino's is not great pizza. I'm sorry, Domino's. I'll put your pizza up against any New York pizza place. It's not going to do well. Okay, but they own sort of the CRM, don't they? I mean, they have everybody's information. They can market to people. I mean, they've built a nice, and they also own the delivery mechanism. I have no idea about the stock. Like, I'm not looking at this. By the way, they are next 4 quarters. Okay, they're 22.25. I was hoping they'd be like 60 or something, and I could be like, look, they're in front of Nvidia too. Yeah, I mean, so who's more expensive, Walmart or Nvidia, Shane?
I'll tell you in a year.
Yeah, there you go.
But again, I think a big sort of what I look back to is Nvidia the Cisco of AI, right? Versus the Cisco and the internet, right? And you lived through that. I did, but wasn't in the market. I was, still playing T-ball. It's a matter of is the music over for Nvidia? Do like chip orders slow? Do sales slow? Is there something up with the circulatory financing and the depreciation and whatnot? But at the end of the day, until it's real or until the market decides that it doesn't think we're going higher, I don't know. And I could see both growing similarly. Like, I don't think this is a situation where going into the next year, Nvidia is going to significantly outpace Walmart. I think it's already had its really big move up over the past 3 to 5 years.
Oh, I think we lost Shane for a second. Mike, I'll come back to you. Mike, you're still there, right?
Yes, still here.
All right. So I think on this, I was also surprised that Tesla is 277 times forward estimates. And so that will be, are the estimates wrong or is the valuation wrong? I mean, that's the other part of this. So Apple at 34, that's probably,
new
historically,
executives.
I'd have to look that up, but
New executives.
Okay. Mike, you talked about earnings though. And the other thing that we are seeing is that earnings estimates are being risen or raised by company guidance. So more S&P 500 firms are raising earnings guidance. I don't know. Oh, this is from Apollo. Okay. And, I'd say 37.5%. You look at the chart, and that's the highest amount since June of 21-ish. But it's worth noting that, in 2020, that's when it really started to rocket. In fact, it reached a high of, I don't know, almost 50% of firms raising guidance. So you have firms raising guidance, you have analyst expectations rising as well. So I think maybe that supports the idea of maybe valuation isn't crazy. Maybe it is. That's why we hedge. Like, I want to be clear with people. We're not saying the market, you should buy the market and because it's going to go up. And I know it's weird to hear people who are asset managers and manage money for a living to say, yeah, we don't really know necessarily in the short run where the market's going to go. We buffer, we hedge. But Mike, you look at this and you say, you want earnings growth. And if companies are raising their guidance, that seems like it's a good thing. And I look at the other times when it was this high, and the markets are pretty good during those years.
Yeah, and you nailed it. I was going to start off my sentence with long term, right? This is what you need for the market to continue to do well. Short term, there are a lot of things that can come into play that can shake up the market and cause volatility, things that, we're not even thinking of here right now, that we're unaware of, that could potentially happen and cause volatility. But long term, these are the things that you need for a strong market and for the rally to continue.
I'm still on the Domino's page, and I was just glancing over. I was listening to everything you're saying, Mike, but I was glancing over, and last 12 months, or let's see, what is this, quarters? Last quarter, they did 137 million in free cash flow. What are their margins? Their gross margin, 39%. I'm looking for some of their other stuff. They paid 1.81% dividend.
It's about flat on the year, looks like.
Oh, the price is flat? Yeah, that's the other thing. So they do 1.5 billion. That's the estimate for Q4. 1.5 billion in revenue, gross margin 39.9. Operating income 289 million. Net income 183 million. Okay. So I have no idea about the stock, but we brought it up. I'd have to look at Walmart too. I got to go back to Walmart though. I think that's kind of surprising. They do a lot historically though, and I haven't looked recently. They've actually done quite a bit of buybacks too, which has helped their share price in the long run. But
yeah, I mean, we mentioned it on the previous podcast too, that, Target was mentioned, that there's struggles with their sort of business, and made it seem like it was a sort of an industry-wide issue. And then you take a look at a company like Walmart, and it just doesn't seem to be the case. They're doing something different here.
I mean, Sears was Sears until they weren't Sears.
Right.
I'm not saying Target's going to become Sears, but these things are cyclical. We see it I don't know if you've been to, what was the store? So right now it's Dick's Sporting Goods is kind of the big national chain. But what is it? Was it Sports Authority before then?
Yeah, there's Sports Authority, Sports Mart, Galleons was one.
Hibbets. You guys ever have a
Sports Authority even still open? I don't even think they are.
I don't think so.
They just kind of went away. You're going to look it up, aren't you?
Yeah, I need to know. If you type in Sports Authority, Dick's Sporting Goods comes up. So.
Oh, okay. Did they buy them?
I actually think they did.
Or they bought the name, kind of like Pets.com isn't the original Pets.com. The company bought the name, or bought the website, I think, from them. So
Yeah, Sports Authority purchased, their intellectual property was purchased by Dick's in 2016.
Yep. Question for you: was Warner Brothers part of the S&P 500? What index were they from? You know, I love this. I love figuring out when new members of the S&P 500 are coming in. So, are you looking it up? S&P 500
I am trying to find it.
Index. Were they?
They are. They were added.
I think so.
April.
I think
Can you hear
Warner
me?
Brothers Discovery was part of. What's their symbol? W something. You know the rule with podcasts: if you can't find it in like 20 seconds, you got to give it up. Nobody wants to listen to us searching for stuff.
Yeah, great podcasting. Yes, I think it was part of it, according to ChatGPT. So we'll just assume ChatGPT's right. Yes.
Yeah. You came back in. So yeah, Warner Brothers Discovery. All right. My point of bringing that up is if Netflix acquisition of Warner Brothers goes through, then we'll need a new stock in the S&P 500.
I believe they're splitting off the Discovery side of the business or separating the Discovery Global, but pretty significant acquisition here, right?
So why does Netflix do this, Shane? Do they want the intellectual property, the movies?
Absolutely. I think, and not only are they getting movies, they're getting music. This is something actually my brother, I didn't know about this until my brother messaged me this morning about this. So shout out to him. He's a big believer in owning physical copies of stuff. He thinks that once everything's digitized, it'll be really hard to even own property. You'll have to usually just pay a subscription fee, and ownership of stuff like this will slowly fade away, and it'll just turn into consistent subscriptions. And so there's a lot of implications in the media sector and streaming, and this could be huge for Netflix. I think this is so big that I believe Christopher Nolan is actually wanting to speak to Netflix directly about their intentions and plans with this, because again, this is pretty big acquisition within that space.
So I'm looking at, they must not, and I was never like a superhero movie fan, but the Dark Knight Rises, right? That's one of those Christopher Nolan. Dunkirk is on the list. I'm just Googling Warner Brothers movies. So Batman is on there, Superman. So what's the, is that DC Comics? Is that, there's those two separate versions. And I know half the audience is like, I can't believe you don't know this, but I don't. I'm not a superhero movie.
Yep. DC is DC superheroes. Or Warner Brothers, sorry.
Okay. So, yeah, I mean, there's quite a bit of movies on here. Your favorite, Mike, Barbie movie. I know you watched that 17 times in the theater. I think you saw that. Let's see. Aquaman, Joker, Harry Potter, the Harry Potter series. So, yeah, I mean, it looks like they'll acquire a bunch of IP, and then I guess you can watch that all on Netflix, I suppose. So there's this thing in economics called consumer surplus, where you're getting more value than you're paying. So I don't know if Netflix rises their rates or not, but does this provide a consumer surplus for people like us?
Yeah, it sort of seems like it. I mean, I'm sure they're going to raise their prices. I think they would anyway, but with this addition, if they're adding all these different movies, I would think they're going to certainly raise. I mean, to have Harry Potter, all the Harry Potters on Netflix alone, that seems like a big deal.
Guys, they own HBO. I think Warner Brothers owns HBO. So you're going to potentially see an entire streaming service wiped, which we said this months ago. Didn't we talk about this in the Zega, the meeting that we had with everybody, we were talking about how we could see this all going back to cable or one streaming service, right? And here they are. If this is true, I think they absorb HBO. And then the question is, do they split that off, keep it HBO and Netflix, and you pay 2 separate subscriptions? Do they package it? Does it all become Netflix?
So they'll
really
own. I didn't realize that was coming in the deal. So they'll actually own the cable channels, the HBO channels, maybe, or do they just own the IP?
That's what. Yeah, there's a lot to unpack here, I think.
Yeah, I mean, sometimes when these mergers or acquisitions happen, it's 2 big oil companies or two big data companies, and you don't really feel it at the consumer level, but this is one that will be felt at the consumer level. Now, I guess the comp for this is Amazon had bought MGM, right? A while back. So aren't those movies just now available on Amazon Prime?
I think so. Yeah, that took forever.
Yep. I don't know why they can't get the movie Youngblood with Patrick Swayze and what's his name? Rob Lowe. Good hockey movie. I don't know why they can't get that streaming somewhere. Anyway. All right, so we'll see what happens. And it's got to go through a regulatory approval. So I guess the options market on this will probably price in a little bit of uncertainty based upon the regulatory stuff. I haven't looked at the options, but we'll see what happens there. So, all right, no more Japan, no more Netflix. Mike, what do you got for recommendations?
Watched a movie, Train Dreams, funny enough, on Netflix.
Okay.
And I have mixed feelings about it. It's a good movie, but it's a very sad movie. So you got to be willing to be sad if you're going to watch it.
This is a heck of an endorsement.
Yeah, I know. It's like really well made, and the story it's a good story. I don't know how to explain it, but it's very sad. So if you like sad movies, you'll really like this one. It's one of the sadder movies I've seen.
One of the characters is haunted by visions and dreams of witnessing an attack on a worker. This doesn't sound. Why are you bringing this up here? Come on.
It's the only thing I got.
I need to work with you on your movie selection. Shane, what do you got?
All right, I'm gonna go. It's her birthday today. It's my sister's birthday. She swears by the new Knives Out, which is, I believe, on Netflix. But it's called Wake Up Dead Man, a Knives Out mystery. Daniel Craig resumes his role in it. It's got Jeremy Renner, Mila Kunis, Glenn Close, Andrew Scott. It's a decent little cast here. Josh Brolin. So yeah, I'm probably going to watch that this weekend. It's a soft recommendation. Next week you'll get my thoughts on it, and something I'm probably a little more firm about afterwards. But
all right, well, we only recorded a podcast like 2 days ago, so this is recording on Friday. It will come out Sunday, but I'm going to do the same thing. I have to watch the F1 season finale, Abu Dhabi, and see who's crowned champion. Next Friday, though, December 12th, the F1 movie is going to be available on Apple TV Plus. So it was in the theaters and those types of things, but it's going to be available now. So I'm looking forward to watching that again. I don't think I have anything else, though, in the last 2 days. I haven't watched anything. I got nothing new. So that's what I got. I'm watching the markets. All right.
Busy.
I think we did it. We got through it. Only a little bit of Japan. We'll kick up Peruvian and money markets next week. We'll have to table that one, Shane, for you. So we'll talk to everybody else next week. And that's it. See you, everyone.